Dr. O, we got some economic data today that I think sort of like, the harbinger data around inflation, the personal consumption expenditures index, which is a kind of I don't know, maybe like a technical term for the stuff that we buy index, up, I don't know, what was the number? 0.4%?
Yeah, it's something like that.
Over the previous
hold on. So you're looking at, hold on, Chris. Let's make sure we got the right thing. We're looking at the right thing. Yes, consumption. That's right. Consumption growth, personal consumption expenditure up 0.4% on the month. Personal income up 0.8% on the month.
Okay.
And, core inflation surprised on the upside. Core inflation was up, 0.4%. This is up from 0.3% last month. And on a year over year basis, we are looking at core inflation at 2.8%, a slight uptick from the 2.66% that we had a month ago. So I think that's the problem, right?
Well, let's call it timeout because we went through, there's like, when these numbers, like when this report in particular comes out, I mean, there's a lot of connective tissue here. So what do these numbers mean? I mean, what's the easiest way to distill this?
I mean, look, if price growth is accelerating,
okay,
then the big question is, okay, do we have a decline in the supply side of the economy, or an increase in the demand side of the economy, or both? Right. Right. And so that's the way to just break it down very simply. And, it seems that we have a little bit of both. Policy uncertainty acts like a supply shock. It gets businesses to pull back on spending, right? In investments. Businesses pull back on hiring workers. They pull back on producing a bunch of stuff because they're like, well, we don't know what's going to happen next. And then consumers usually tend to pull back. So you get a little bit of demand, easing back. But then if consumers begin to suspect that prices are going to be higher in the future because of all this tariff talk, right? Some consumers might actually think, hey, it's better to get my stuff today than to wait until prices are higher in the future to go and buy stuff.
All right. So pre-show, you said that. So I have to ask this question. Do you think people really think about things in those terms, or do you think that just PhD economists think about?
Well, look, all you got to do is look at the U.S. consumer sentiment numbers.
Okay.
We know that consumers.
Right. And that number came out today, and that number, right. And again, we're recording this on basically the last, it's Friday, March 28th, right?
Yeah.
Pretty much at the end of the month of March here. And I mean, the sentiment was bad. Like the worst that the number's been in 2.5 years. I mean, it goes back to 2022. But that's a sentiment, right?
So,
I mean, and
the reality is consumer spending had dropped last month. It rebounded, but it rebounded less than expected. So to me, what that tells me is that, you still have consumers kind of on edge. They're on edge not only because prices are stubbornly high and it's going to be difficult to keep up, but they're also on edge because their income prospects are dwindling. The job market is, employment growth is lower.
Yes.
Hiring rates are at a decade low. And even though we haven't seen a big increase in layoffs yet, it's very difficult. If you're unemployed, it's very difficult to find a job right now.
I was flipping through. Okay. And on that vein, I was flipping through LinkedIn because you had mentioned, I don't remember what it was. You'd mentioned something to me and I went to LinkedIn to look at it.
Yes.
And there was a story on there and I believe it was in video form, but the grist of the story was this, that people who are looking to change jobs right now should not be expecting significant wage increases or any wage increase necessarily if they're changing jobs. So, I mean, that's all right. That's in LinkedIn, right?
Yes.
So that's what,
it is
probably certainly more white collar, right? I mean, but I mean, but why? I mean, and why would you change jobs if you weren't going to be getting a,
well,
I mean, maybe
exactly. And that's why the quit rate is so low.
Yeah.
People are not changing jobs. They're not changing jobs anymore, because employment prospects are falling. There's just not a lot out there. Now, if you add to that, federal government job cuts, and you have a lot of unemployed workers, newly unemployed workers adding to this pool of job seekers. And yes, it's right. There's just not enough employment to go around for this group. And so like the competition among workers is so high that, and at the same time, you combine that with the fact that hiring rates have fallen, right? The demand is just not there. Then you have a cooling labor market. You have a loosening of the labor market. Wage growth is likely to continue easing. And then if you have stubborn price growth because of tariffs and retaliation, et cetera, well, guess what? Your purchasing power decreases as a consumer, and that's going to cause consumer sentiment to plummet. And we're seeing it already. So that's kind of what there is to say about this report. It's not positive. It's not positive for the consumer. It's not positive for the Federal Reserve that was hoping that, right. So the last thing you want at the Fed is growth to slow, the unemployment rate to increase, and inflation to increase at the same time. Remember the dual mandate. What we'd like is for inflation to moderate, come down slowly.
Yes.
And if growth is falling at the same time, right, then that would mean the Fed could actually cut interest rates to help stimulate the economy. But if inflation is rising and the unemployment rate is rising at the same time, what is the Fed to do? It is kind of stuck between a rock and a hard place.
Well, and in those circumstances, they basically they pass, right? And they wait. Right.
And that's exactly what they're doing. They're waiting to see what's going to happen, and hopefully they won't wait too long.
All right. So forgive me if I'm getting this wrong, but I need to go back to LinkedIn since you're the master of LinkedIn. Did you have a post last week? You're absolutely like, you got a 10-star rating on LinkedIn. Did you have an item this week, where you were forecasting one more Fed cut this year?
So I look, I see it coming.
Okay.
And the reason
talk about that. So when and why? The
reason I see it coming is because historically the Fed has always been somewhat biased towards the unemployment mandate.
Okay.
The inflation really has to move substantially higher to get the Fed to think about inflation. Right. We saw that when the talk was about transitory and not transitory. And so if the labor market deteriorates rapidly, I think the Fed will jump in to save American jobs, and tolerate slightly higher inflation. You see? And see, that's why, we've had a conversation on this podcast about, hey, maybe the 3% is kind of tolerable. It's the new normal. We're okay with 3% so long as we have jobs, right? We've talked about that a little bit on this podcast. And I think that's exactly what could play out, in 2025.
All right. Well, hey, I appreciate the conversation.